Hi guys, welcome to week 4 here for financial accounting. Just wanted to welcome everybody to the week and kind of get us going here. So this week we're covering the chapter on completing the accounting cycle out of the textbook. So really what we're after here in these videos and things is kind of understanding the difference between permanent and temporary accounts. We can think about our permanent accounts as those accounts that continue from period to period and don't really go away. So we can think about like cash or assets as permanent accounts because the cash I had when I went to bed last night is the same cash I had today. And so if I don't spend any money this week, right, then I have that same $20 sitting in my wallet, right? But instead, temporary accounts are used for keeping track of activity for a specific period, temporarily for that given month, year, quarter, whatever that period of time happens to be. And so that's kind of an important element as you get going with chapter 4 here in week 4. Just wanted to showcase or kind of highlight a few different areas. As we work through chapter 4, what you're going to have, there's those video links within Moodle, but also I wanted to just draw your attention to the worksheet. Okay, so what the worksheet is showing us here is we have our unadjusted trial balance. So the transactions that we've recorded for a given period of time have put us in these balance positions at the end of this month or year, whatever our period happens to be. And so what we're ultimately going to be working on is using this worksheet to first adjust our accounts to get them to an adjusted basis, like our insurance, right? That was an example from last week where we prepay insurance, we have an adjustment to that account, and that gives us an adjusted trial balance. So the insurance that lapsed or the insurance that got used up for a given period of time. So what we're going to do is we're going to start with our unadjusted trial balance. We're going to post our adjustments. We're going to then work that adjustment into our adjusted trial balance. So let's see here. We have some adjustments being posted here within this particular example. So the $8,000 debit, a $9,000 debit gives us a new debit balance of $17,000. So this is our adjusted trial balance. Now what we're going to use these last 4 columns to do is to just organize those accounts based on which financial statement they would show up in, okay? So our balance sheet accounts is going to be our permanent accounts. So things that have a balance that are going to continue. So our assets, our cash, accounts receivable, land, our liabilities, accounts payable, long-term notes payable, as well as our equity, our capital, our withdrawals. Now what you'll notice here after the withdrawals is we switch over to our income statement where we're going to be focusing on our revenue earned and our expenses incurred. So we have our revenue of $79,000, the expenses that go against it. Notice when we add up these columns, okay? Notice how they don't balance, okay? That's because we have this aspect of, because we've kind of split up those accounts into balance sheet and income statement. Now we have this disconnect where when we add up our debits, it does not equal our credits. The difference is because we have a net income. The $79,000 in revenue minus our $64,000 in expenses is giving us a net income of $15,000. So what we're doing here in our worksheet is we're calling that net income. We're adding it to the debit in our income statement. We're adding it to the credit in our balance sheet. And because that debit and credit are still kind of like a zero impact, but that brings us into balance full circle within our financial statements, okay? So that's what we're going to be working on with that worksheet. You're going to have an example of one to work through in that Connect assignment for the chapter homework. And then ultimately what that's going to lead into is also our closing entries, okay? And so once we've prepared our balance sheet and our income statement, our statement of shareholder or stockholder or owner's equity, what we're going to do is we're going to zero out our temporary accounts and close those into our capital account. So all of these are going to, one by one, fall into this capital account because we're going to start the next year with a clean slate for those temporary accounts. We're going to reset them all to zero. So withdrawals is going to be credited to bring it to zero. Fees earned is going to be debited to bring it back to zero. Our expense accounts are going to be credited to bring them back to zero. And we're going to work our way through that income summary account that you're going to hear and read about. But just kind of wanted to give you a little bit of introduction to some of the different facets of this week. So as you work through Chapter 4, let me know what's not making sense. Please do reach out with your questions through email, phone, text, the discussion Q&A, messenger through Moodle. So have a great week, guys, and look forward to hearing from you soon. Take care.